A shocking new Fed inflation policy has just been released. It's only the third policy change in over 100 years. And in this video, I'm going to explain what they just did, what it means, and of course, most importantly, what you need to be doing right now. Now, this is exactly what the most elite group of the 1% are doing right now, and you should be too. So stay tuned. All right, welcome back. If you are new to the channel, my name is Mark Moss. I do these videos because I believe the only way to have security in life is for us to take responsibility for ourselves because the system is broken. No one's coming to save you, and that's why you must learn to make money, grow your money, protect your money on your own. Now, if you agree, you want to hear more about these types of topics, click the like button right now so more people hear those topics, and of course, hit the subscribe button and the bell notification so you're notified every time I put new videos out. Now, as I was just saying, some really big news came out from the Federal Reserve last week. It's the third time in 100 years they've changed their directives. Now, I'm going to explain, and at the end, I'm going to give you actionable steps to make. So make sure you stick around to the end. Also, I'm still running the $1,000 Bitcoin giveaway. It ends in just a couple of days. So if you haven't already entered, click the link in the description. Now, I did this because I get offered money all the time to promote products. And I figured, you know what, instead of taking money, let me just offer it back to you. So I'm doing that as a gift back to you. So don't miss the chance to win that Bitcoin, the hardware wallets, and so much other stuff. Click on the link in the description to be entered, like I said, just a couple more days. Now, getting back to what the central bankers, the Federal Reserve, have in store for us right now, what's next. Now, every single year, the world's elite bankers, they gather in Jackson Hole, Wyoming, and they gather to discuss, well, banking, right? Banking stuff. Imagine this group of banking people, the banking and the monetary elites, and they gather in a room to discuss the world's money. And just thinking about that in my head, it makes me think of this quote from Mayer Rothschild, who said in about 1800, he said, quote, "Give me control of a nation's money, and I care not who makes the laws." So powerful, isn't it? And that just basically means who cares about the laws? If you control the money, you control everything. That's what he was saying back then. And of course, we know that's pretty true today, or maybe even now more than ever. So these bankers, they get together and they plan, what's next for the world, how to control, how to affect it, how to control the monetary policy, and arguably, the most important and powerful person in that entire room would be the U.S. Federal Reserve Chairman, Jerome Powell. And basically, everybody was hanging on his powerful words, powerful enough to move the markets last week and move them in a sustained move that has really big implications. In fact, what he said was that the Federal Reserve was going to change its policies, change its objectives for only the second time since its creation. Now, to understand this, we have to take a trip back in time. If you're new to this channel, maybe you haven't seen this before, but I love to go back in history. We do this all the time. So let's jump back in the time machine, and we are going all the way back to 1913. This is the year the Federal Reserve was formed. Its main objective was to establish financial stability in the U.S. by overseeing the monetary policies of the banks. Now, in 1933, the Federal Reserve again changed its policy mandate through champions like Senator Glass and Representative Siegel. You might have heard of Glass-Steagall before. And they increased regulations on banks, and they also created the FDIC insurance, the depositor insurance. But the last big policy shift we saw with the Fed came in the mid to late 1970s, the early 1980s, and that's when the U.S. experienced the worst inflation since the Civil War. Prices of everyday goods and services were exploding higher like crazy by double digits, and Americans found that the amount of money they previously paid for 2 months' rent soon would only cover about 2 weeks worth of rent. That's what inflation does, and it was happening so fast at that time. Now, it wasn't until 1980 when Fed Chair Paul Volcker, he raised interest rates to an astonishing 19%. That finally the nightmare ended. 19%, imagine that. We're at like 0% today. Imagine paying 19%. But that was the drastic steps that he had to take in order to curb the inflation. Now, the episode was so horrific that Congress actually changed the Fed's mandate for the first time since 1933. And as I said prior to this, the Fed's primary purpose was to maintain financial stability. Now, this had meant that the Fed was there to stop bankers from going bankrupt. There was banking crises happening. But following the inflationary nightmare of the 70s and 80s, the Federal Reserve Act was amended to, quote, promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates, end quote. So stable prices equals controlled inflation, or at least that's what they think. Now, from this point onwards, the Fed began to target a very low but steady rate of inflation. As this policy developed, the Fed eventually settled on a target rate of about 2%, which of course you've probably heard, at least if you've been on this channel, right? 2%, 2%, 2%. So starting in the early 80s, the modern financial theory began to incorporate this idea as a targeted inflation rate. That's what the Fed is always going for, trying to target 2% inflation. Now, every major trading model, portfolio allocation model, and money management strategy all involve this target inflation that the Fed was striving for. Now, of course, the real rate of inflation most Americans experience is, of course, much higher. In particular, the cost of items like energy, food, education, and healthcare, they've all skyrocketed in the last 40 to 50 years. Now, the Fed hides the fact by claiming that the real rate of inflation needs to incorporate the cost of all the items, not just the essential items. And because the cost of things like TVs, cell phones, furniture, things like that have generally become cheaper, then the Fed claims that this evens out the rise in price of other items like essential things like food and healthcare. Now, I'm not saying I agree with any of this. As a matter of fact, I don't. I'm just simply telling you that this is what the Fed thinks about inflation. So for however they calculate inflation and their stated goal of 2%, they just haven't been able to achieve it. They've been trying really hard and they can't seem to get the inflation that they want. Now, this is a big difference from the 80s when Volcker and the central bank were actually fighting inflation. Now at the meeting, Fed Chair Powell gave us a new view of their inflation targeting, and here is what he said, quote, many find it counterintuitive that the Fed would want to push up inflation. However, inflation that is persistently too low can pose serious risks to the economy, end quote. So they see this low inflation as a serious risk to the economy. And so now their new objective is, quote, maximum employment. Now, it's worth noting they didn't see a number on which they see maximum employment. We don't know what that number is. They're just saying that's their goal. Now, is it 5%, 3%, 10%? We don't know. But rather, they confirm that their new objective will be maximum employment and inflation. Again, whatever that means. What was interesting is that Powell did note that the Fed was aware that higher prices for things like food, gas, and housing were adding burdens for families. But he said that the risk of low inflation or even deflation is an even greater risk and could somewhat limit the ability of the Fed to stabilize the economy by cutting interest rates. Also, Powell once again confirmed that the Fed's strong commitment to using its full range of tools to help the economy, note, print more money, in order to manage its dual mandate of stability and full employment, which it believes can be the most effective with inflation flexibility. See these words they're using? They want to be flexible. They don't want to pin down to a target anymore. So needless to say, the shift in Fed thinking is a big difference. It's a far cry from the 1980s when back then Chairman Paul Volcker ramped up inflation rates in a big way to fight the effects of runaway inflation. But of course, we're living in a different world, right? It's completely different. As a matter of fact, whatever they're calling the new normal, things have changed. Things are disconnected. Now, of course, Paul Volcker, he's no longer with us. He passed away late last year, but I don't think he would even recognize the Fed policy that we have today. He'd probably be rolling over in his grave. Of course, the Fed policy, which as of today is basically no policy, or like I said, at least not trying to tie themselves to any specific number or formula for the inflation average or now this new employment number. Now, this new policy confirms what I've been saying for a long time. That the Fed will do anything and everything it can do. It will continue to expand their balance sheets and use their cheap central bank credit to continue to drive markets higher and higher. And just as you might expect, the stock market, futures, gold prices all rose higher during Powell's speech, with the S&P 500 and the NASDAQ open the next day at record highs. Now, we know for sure that the Fed is desperate for inflation, but just because the Fed wants inflation doesn't mean the Fed will get inflation. Now, I don't think we're going to see the Fed get anywhere near the 2% target in the near future, especially with unemployment still really high. It's still over 10%. Now, it'll probably come eventually that at some point we're going to get the inflation, but I just don't see it happening in the near term. Now, if inflation was an immediate issue, it would make no sense to hold on to cash, right? Since inflation is eating away at its value. So if it doesn't make sense to hold on to cash, what are the 1% elite doing with their cash right now? Success leaves clues. So let's take a look at the elite to see what they're doing with their cash when it doesn't seem to make any sense. Now, when we look at the elite, when we look at the 1%, we're starting to see that they're actually starting to hoard cash. Now, I'm not saying to sell everything. I'm not saying to sell everything and move to cash, but you definitely want cash to be at least one part of your total portfolio. Now, it's actually one of the 4 pillars that I teach in my 4-pillar portfolio private group. But this one elite group of investors, they're called Tiger 21. You can look them up. But Tiger 21, they are part of the 1%, and they've increased their cash holdings to 19% of their total assets. And that could be, that could be a good ratio for you, depending on what your own specific situation is. But of course, depending on what you see in the market and with a prolonged slowdown on the horizon, many of these investors plan to weather the storm by keeping and building their cash reserves. Now, they seem to be thinking about, another bubble bursting. And of course, that's completely justified. This can't go on forever. I mean, the Fed is continuing to pour in liquidity at record amounts. And they've been doing that ever since the pandemic started, and really even earlier than that. And it's obviously worked. I mean, stocks are up huge since their lows. I mean, we're at record highs, but it's not going to stay that way. So these elite, the 1% in the Tiger 21, they want to stay in the markets because with the ongoing continued support from the Fed, the huge returns coming from tech companies, the market seems to be hitting on all cylinders, right? Regardless of how bad the economy is, the markets are crushing it, especially the NASDAQ. Like I said, it's all new time highs. But just because they want to stay exposed for more upside, they want to continue to get more profits as the Fed pushes this market to, unimaginable heights. They're also increasing their cash reserves at the same time. So they're taking some money off the table. And if some of the smartest and wealthiest investors in the world are doing this now, maybe you should too. Now, if you want to know how to stay in the market for the upside and protect your investments in case of a market crash, and exactly how to increase your cash reserves, and then, more importantly, what to do with those cash reserves, then check out the free training I did. It was a couple of weeks ago. I did it live, but you can catch the replay by clicking on the link in the description. And of course, like always, leave me a comment below and tell me, are you considering 1, staying fully invested and riding this market all the way to the top? 2, starting to increase your cash positions? Or 3, are you just cashing out, getting out of the market and just going to wait and see what happens? Leave me a comment. Let me know 1, 2, or 3. And of course, if you like this video, give me a thumbs up on this video. If you don't like the video, that's okay. Give me a thumbs down, but leave me a comment and let me know either way. 1, staying fully invested and all the way to the top. 2, starting to increase cash. 3, cashing out now. And of course, watch the replay of that live training I did a couple weeks ago. It's in the description. You can click on it right now. And that's all I got. To your success, I'm out.